So let's unpack, how do we review the balance sheet? What does that look like? So the balance sheet evaluation, I want you to set the stage. So the balance sheet evaluation provides this comprehensive picture of the financial health and stability of the company. It starts with examining the cash management. So you're going to evaluate the bank accounts, how the company moves cash through the business. Um, Are they using multiple accounts? Are they using a few accounts? You want to understand the cash practices of the company when you're doing any level of due diligence. I always say cash is king. Uh, how cash moves through the business may also look different than what is being shown on the financial statements. That's for a later topic, but just keep that in mind when you're evaluating the balance sheet, especially in asset-heavy businesses. Think businesses with lots of inventory, significant accounts receivable, etc. If you're doing an asset purchase, you're buying what is effectively on the balance sheet, in addition to goodwill and other intangibles, the name of the business, the goodwill of the company. If you're doing an asset sale or really any acquisition, you're buying what is on this balance sheet. So what that looks like is really the crux of why this analysis is so important. I always say that most folks know enough to be dangerous to read a profit and loss statement, but when it comes to a balance sheet, there are certain things you may overlook, which are very material to your business acquisition deal and the price you ultimately pay. So what else is included in the balance sheet? We're going to have things like accounts receivable. So accounts receivable is likely one of your most significant current assets on the balance sheet. So the ways you can assess the accounts receivable is by pulling, an aging schedule. Typically, aging schedules will show receivables outstanding, which are 90 days, 60 days outstanding, and then 30 days. You may have 120 days aged outstanding. Um, for those of you not very familiar with like cash, practices, 90 days outstanding is if you send a customer an invoice, that invoice was dated 90 days ago, from, the date the work was performed. Depending on the typical terms of the small business you're looking at, a lot of businesses operate in net 30. Most invoices are due within net, 30 days. Um, Government municipalities may operate as 60 days, so a net 60. If you're not comfortable with the lingo around, accounts receivable, such as aging schedules, unbilled receivables, uh, net 90, 60, or 30, I would beef up and do some independent research around some of the terminology. The last piece in the balance sheet is the accounts payable. So the accounts payable, it shows what is currently outstanding. It might have things such as vendor payables. Um, Other current liabilities will include payroll liabilities. If you have a staff, etc. So those are the big buckets of the balance sheet. One thing not listed here is inventory. Depending on the business, inventory might be very applicable, or it might not be applicable at all to your deal. Um, in manufacturing deals specifically, inventory is a significant component, raw materials. So any kind of manufacturing company or other small business with goods or raw materials on hand, inventory is going to be probably your most important evaluation of this balance sheet. Um, so those are really the three buckets. Again, cash, AR, AP, inventory is going to be really the significant components of the current balance sheet. So it's helpful to set the stage before we dive into some of the analysis. So moving on, So as we think about this balance sheet review, what else is included in it? So if you see on the graphic on right, um, the balance sheet review is a component of financial due diligence. So let's take a step back. If you're actively searching for a business, once you obtain a letter of intent or LOI, you're going to enter the period what is, known as the financial due diligence period. Um, Within that, there's several analysis uh, you should be doing to assess the financial health of the business. One piece of that is the balance sheet review. So other things to think about when you're doing a balance sheet review is uh, looking at related party relationships, understanding the inventory structure. Is it how does the company record inventory? Is it a FIFO, first in, first out? Is it a LIFO, last in, first out? For those of you not very comfortable with accounting lingo, again, do a little bit of independent research around inventory methodologies on an accounting basis. If you're pursuing a business with significant inventory, it's important whether or not you hire a third-party CPA advisory firm to do due diligence for you. It's important you begin to understand the ways the companies can account for these inventory items, because more often than not, you're going to be buying this inventory on hand. So how they account for the inventory is very important to make sure you're paying a fair price for goods which can be sold. Uh, if you have any questions throughout this webinar, feel free to throw them in the chat and I will get to them, in the middle point or the end. Uh, Coming up a little bit later, we have a free toolkit. So if you want to stick around and scan that QR code, you can get that on your desk today. So we talked about the due diligence timeline, but it's important. I always like to share this. So if you are actively pursuing a business deal or just starting out with your search, feel free to take a screenshot. If you have a snipping tool, snip this and save it to your desktop. I use this on every single one of my deals. And it shows what is a timeline for a typical 90-day due diligence period. So a 90-day due diligence period, picture this. You received the signed LOI yesterday. What does the first 30 days look like? If you assume you have 90 days until you run out of exclusivity, meaning the business can be solicited for sale elsewhere, uh, what do you need to do during those 90 days? This graphic does a great job of showing, a timeline and chart, typically kicking off financial due diligence, such as the balance sheet review, as well as the bank process, is important in the first 30 days. From there, you're going to work with legal and tax folks during the later stages of your deal, M&A attorneys, other tax professionals to get you, and that last window is when you sign the purchase agreement and those closing documents. So let's walk through a case study of a multi-location business purchase and the analysis. So this is going to be a balance sheet review for a few different entities, and we're going to show some key takeaways of it. So let's unpack a singular balance sheet. So picture this. You have just received, you're under LOI and you've been given access to the company's QuickBooks files. The first thing I would recommend is generate a monthly balance sheet report. So you're going to go into QuickBooks, you're going to select if the company reports on an accrual basis or a cash basis, and then you're going to run the period of analysis you'd like to see. Typically, I recommend a 3-year period. So today is January 2026. For simplicity purposes, let's do it over 23, 24, and 2025. So you would run from January 23 up into December 31st, 2025. Um, and what would that look like? Then, if you do it on a month-to-month basis, it would return a report that looks like this. So it's going to show monthly balance sheets and then the individual accounts. So I'm going to zoom in and we can walk through a couple things already pre-highlighted here. So when you look at this balance sheet, and feel free to throw it in the chat, what do you see? What things stick out to you? What are some observations? I find it very important for hands-on learning, so I'd love to hear from some of you. What do you notice, or what questions would you ask management about this balance sheet if you're looking at it for the first time? While we're thinking hard about those questions, a couple key takeaways, and I've highlighted these to kind of give you the answers and visuals. So the accounts receivable looks like it goes from 685,000, drops down 12 months later to about 553,000, um, decreases again to 328,000, and then increases to about $1 million November 27th, 2024. So when we were running this report, this was the most available recent date close for the business. This business acquisition was in late 24. So this was the last period available. Um, so you'll see that something has changed in the last 12 months in accounts receivable. So this is a concern for a business acquisition, especially if you're going to be inheriting and buying the balance sheet. You want to make sure that those balance sheet items that are sitting in accounts receivable are collectible. You'll see the business, when I look at this balance sheet, I would expect accounts receivable to be closer to the typical average. The typical average was about 600, 500, and then it dipped down to 300,000. So what's changed with the business to cause such a spike in accounts receivable? You could start with asking some open-ended questions, like have there been changes? Have there been changes to payment terms? And Daniel, you read those are the exact words I would say, so well done, and appreciate your contribution. Have there been changes to the terms? Have you acquired new customers which may mandate less favorable terms? So I'll say that again. Have you acquired new customers that they don't pay for 90 days? So maybe they're working with larger enterprises. Um, Maybe they're working with municipalities which have very rigid 60 or net 90-day terms. Maybe this is a construction company. Construction companies typically have very long collection periods, and that's like the industry standard. Um, those are some of the questions I would ask, and you want to ask it in a way of collectability, but also like what's changed with the customers? Because ultimately, if accounts receivable is increasing, I would expect sales to increase. If we look at December to November, if I were to flip over to the income statement, I would expect revenues to significantly spike in this period. If you're telling me that there's $1 million of accounts receivable, which is collectible, I would expect a significant revenue uptick. So enough on accounts receivable. What else would we look at? If we scroll down, you have another line item called 1201 other accounts receivable. I would probably ask about that balance. Since it doesn't contain a balance in 24, I wouldn't be as concerned, but I would still want to know the nature of it. Another one I would ask for, since we talked about it, was look at the checking and savings. So while the AR increases, the operating cash or the total checking savings actually declines by $1 million. So Is the business requiring more cash to operate? What's going on with the changes? I would probably want to unpack the cash activity through discussions with management and that bank statement review. If we flip over to liabilities, so when you take a look at the liabilities, what jumps out to you? What are some of the questions? Two, which I would ask for, I would want to see an accounts payable aging detail. That's going to show the vendors and what makes up this accounts payable balance. You'll see that in 2021, the business had $1.4 million of accounts payable owed as of December 31st. Uh, Fast forward 2+ years, that accounts payable is virtually zero. It's only showing about 65,000. So what's changed with the vendors of the business? Has the owner negotiated more favorable terms? Um, or has the vendors pushed back and actually demanded less favorable? So maybe you need to be paid when paid, or net 15 or net 30. When I see accounts payable significantly lower, but AR is going up, that signals to me that the vendors are requiring faster payments than what is coming in the door. So cash is coming out the door faster than coming in. That can cause what is known as a cash crunch, which is something I talk about frequently on some of the social platforms. When you're buying a business, you need to understand what does the cash activity and the cash needs of the business look like when you're inheriting the business on day one. If you don't have the cash resources to continue the business, you may enter a cash crunch and you may need to use other resources, hopefully readily available to keep the business afloat. So when I look at this business, you want to unpack AR, you want to unpack AP, and then maybe ask a few questions around some of the other items. If we keep it moving, one other thing on the balance sheet review, and before we get to the full company, if you want to take out your phones and scan the QR code, I'll show you, and we'll take a 5-second pause for the business buyer's toolkit. So this toolkit is something I put together over the last decade. It has 90 pages of um, tips, balance sheet reviews, how-to guides. If you want to scan that QR code, you can download your copy today. Um, while we wait for a few folks to scan that QR code, if you have any more questions or comments thus far, feel free to put those in the chat and I'll try to get to them after we walk through the consolidation. Hmm. Alrighty. If you want to copy and didn't get a chance to scan that, feel free to reach out after, and I'll be happy to share a link with you. So let's take a look at the consolidating balance sheet review. So let's give it a little backdrop to what we're looking at here. So this is a balance sheet for a 3 repair shop auto repair facility. It shows the balance sheet of shop 1, shop 2, shop 3, and then a company grouping called, operating company. So effectively, it's a three-shop business. So let's take a look at what's going on with some of the individual shops. So if you're buying a business and it might have multiple locations, pay close attention to this. So a couple things that jump out, you'll see that accounts receivable is pretty steady across each shop. It has about 60K, 80, shop two has 60,000 roughly each period. Shop three, which is a newer shop, which didn't open until 24, again, had very similar receivables. It had 58,000 and then it had 76,000. Um, yep, you'll see that here. Just going to draw a little line for your aid. But one significant accounts receivable which jumped out in shop one was the business was showing $342,000 June of 25. So if we look at the balance sheet of the business, that represents a significant portion. So you're going to want to unpack at the shop level, what are those receivables look like? What kind of customers? Again, we're starting to ask similar questions, but it's important when you're looking at multiple balance sheets, you stick to the same criteria we already established. So focus on material items and material changes year to year or period to period. When I see things like significant spikes or declines, you should be asking questions. So what else is going on with this business? So this business has some inventory. So it has raw materials. If I were to guess, it's going to be raw materials related to cars and the repair work they do. Um, Again, the business's inventories are roughly stable. So shop three looks like it has about 40,000 of raw inventory. This shop, a little bit less. And then shop one has almost double. So if I were to guess, I'd say shop one was the first shop created. It might be the largest shop the business consolidating entity serves. I would expect shop one to have the most revenue, the most expenses, and probably have the most profitability of each of them. So from a risk standpoint, shop one is probably most material to the deal. Shop three, given it's new, is also important, but from a time management perspective, if you are under the gun and have a time crunch, I would spend a lot of time unpacking shop one and then maybe what does shop three look like? If we keep it moving, um, if we look down the list in the liability standpoint, a couple things jump out. Accounts payable in shop one increases. Again, I'm not surprised that this went up. When accounts receivable increases, I actually expect payables to be in line. To me, that shows a healthier business, and a business that is less likely to have a cash crunch because they're not having vendor payment changes. Even though their AR might be going up, it's steadily increasing in line with, AR and AP. Um, if we continue scrolling through, it looks like Shop 2 has significant accrued payroll in June of 25. I would ask questions if they had um, new hires in payroll for Shop 2. My guess would be yes, based on how these liabilities are, based on what the liabilities are telling us. You'll also see that accrued expenses increased 71,000. I would want to unpack what are those accrued expenses? Um, you know, is it material? Why have they changed, etc. Couple other things would be it looks like the business has a line of credit. So it's important if you're doing an asset or stock sale to unpack the line of credit um, and make sure those terms carry over. One thing which comes up, and I saved it for last, was we have this line called intercompanies. So intercompanies I see frequently when there's multiple locations, or in this case, multiple shops. So if the business has intercompany activity between shops, or I see a lot of intercompany when they have this company operating entity within the QuickBooks file. This is going to show activity between the shops. So a couple things to keep in mind when you're doing intercompany. In a perfect world, if the business is routinely updating its records, the intercompany activity when on a consolidated basis should be very close to zero. So why is that? If we think about accounting methodology, debits equaling credits, if company one lends, if company one lends out um, a vehicle or another asset to shop two, the entry would be, loan to shop two, payable back to shop one. That would net to zero. So you want to understand, and I always put together a schedule of intercompany activity. You want to see what are the components of it and really make sure that there's nothing that's slipping through the cracks um, at each of the individual entities or in consolidation. So you want to, again, for intercompany activity, create a schedule and unpack those components and ask management questions about um, what does this relate to? How are they updating the intercompany activity? Just to make sure there's not related party transactions within them. Um, One last line item is loans from shareholder. Typically, loans from shareholder will be owner related. They may be employee related, but those would typically be like employee advances. Uh, so when you're buying a business and you see loans from shareholder, ensuring that these are paid off and settled prior to closing is best practice. So if there are other shareholders that the company has loans out to, making sure that those are settled up prior to close, understanding who these shareholders are is what I would do for this. Um, those are all of my key takeaways for the consolidated. Again, this is showing the balance sheet on a monthly basis for 3 or 4 entities, shop one, two, and three, and then the company level. Um, as you navigate deals, keep this in mind and use some of these learnings for your benefit as you look through these multiple entity acquisitions. So I think I highlighted some key takeaways if we want to keep it moving to the next slide. So let me close out of this. Oh, see if I can erase it. There we go. So shop one, balanced growth leader. So you notice that the assets went from 1.3 to 1.9 million, about 45% growth over the period. So to me, again, some of the takeaways were shop one likely was the first shop as part of this larger entity business. Um, it serves as the financial anchor of the portfolio. It's probably the best performing shop from a revenue and profitability standpoint. When you're assessing the financial health of the business, I would spend a lot of time understanding what works well for shop one, and then how can that be used to scale up shop two and shop three. So shop two, again, assuming that this was the second store open, had about 153% growth in assets. Um, To me, it indicates early stage operations and it's a self-sustaining location. Shop three is where you can deploy some improvements. So the assets grew by about 50%. It seems like it's a relatively new location. So understanding what works well in shop one and two and applying that to shop three would be ways to position yourself for future growth as you assume this new business. So when we think about net working capital, and that's a great question, Daniel, you don't want to include intercompany receivables. Those would be pulled out. So if you think about how a net working capital template or net working capital analysis is put together, it would include the intercompany receivables on the reported net working capital. And two of the adjustments you would make is typically I would take out cash and debt-like items, which are captured in current assets or current liabilities. And then I would also pull out intercompany items if they are included on current assets. One thing that people get tripped up over, if you see intercompany receivables or intercompany, but it's included as a long-term asset, you would not pull that out for net working capital because net working capital is current assets less current liabilities. Not to be confused, it's still important you understand what those intercompany items relate to, because that's a quick way to assess if there's related party activities you have not learned about yet. If we want to move over to the next slide, we'll wrap this up in closing. Um, so, in conclusion, the balance sheet has a lot of great fundamentals. It can assess the accounts receivable. By understanding it, you can better learn some of the asset classes. What are the operating activities look like from an accounts receivable and accounts payable standpoint? Um, if there's multiple locations, it's important to see how each of them are performing independently. And if it makes sense that you have three locations currently, would it make sense to open more, etc. By isolating and analyzing it at the entity level, if it's one entity or multiple, it gives you a clearer understanding of the health of the balance sheet and the business, that supports it.